3 weeks ago, 1.2 million investment accounts in South Korea were wiped out in just a few days. Not because of war, not because of an earthquake, just because of a single red number on the screen. Right now, 1 out of every 30 people in South Korea is getting a warning text from their broker. A text message that says, either deposit the money tonight or tomorrow morning we'll forcibly sell all your assets. This is happening right now, at this very moment, as you're watching this video. I want to show you why this is exactly the kind of scenario that could play out in the US market in a few months. Let me start with a number. Up until 3 weeks ago, South Korea's stock market, called the Kospi, was the most profitable stock market in the world. In 12 months, it had grown by nearly 200%. For comparison, the US market grew only 24% during the same period. That means South Korea was growing 8 times faster than the US. One of the Korean companies, called SK Hynix, grew by 1,000% in just 1 year. So if you had invested $100, you would have $1,000 now. But after just 21 days, all those profits went up in smoke. The Kospi dropped by 25%. Now the question is, how can a stock market crash this badly in just 3 weeks? The answer is just one word: get. There's a really heavy cultural pressure in South Korea. If you don't own a house, aren't married, or don't have a good job by a certain age, it's like you've fallen behind in life. But housing prices in Seoul have gotten so high that for the younger generation, buying a home has become an unattainable dream. That's why millions of young Koreans have come to the conclusion that the only way to get rich is through the stock market. 14 million people, that's a quarter of South Korea's entire population, have entered the stock market. They call themselves ants. A single ant can't do much on its own. But when 14 million ants move together, they can shift an entire market. But these ants didn't just invest with their own money. They took out loans, put up their future salaries as collateral, and worst of all, turned to leveraged funds. These are funds that amplify the market's movement by at least 2 or 3 times. If the market goes up 1%, you make 3% profit. But if the market goes down 1%, you lose 3%. One person even admitted that because his family didn't know how much risk he'd taken, he wasn't even willing to show his face on camera, even though he had a $650,000 account. But all that money was bet on just 2 companies, Samsung and SK Hynix. These 2 companies alone make up more than half of the entire South Korean stock market. For comparison, the US stock market has 500 companies, and its top 10 only control 36% of the market. But in Korea, 2 companies control 56% of the market. In other words, the stock market of a country with 51 million people had basically turned into a single volatile and risky stock. And the reason these 2 companies had grown so much was nothing other than artificial intelligence. Samsung and SK Hynix are the main producers of advanced memory chips that AI data centers need. Big American companies like Microsoft, Google, Amazon, and Meta spent $376 billion just on AI infrastructure last year. But this year, that number will reach $725 billion, and a large portion of that money goes directly into the pockets of Korean companies. So in reality, 14 million Korean investors were directly betting that America's AI spending would never stop. Now, let's talk about what burst the bubble. At the end of June, the stocks of American chip makers started to drop. Why? Because investors were worried about the financial report of a company called Micron, the main rival of Samsung and SK Hynix. That worry alone, just the worry, not an actual event, was enough to shake up the Korean market. In a single day, the Kospi dropped 4.5%. A week later, Samsung and SK Hynix shares each fell by more than 9%. And then we reached the day Koreans call Black Tuesday. The Kospi dropped more than 10% in a single day. To understand how big this is, a 10% drop in one day would be considered the 3rd biggest crash in the history of the US stock market, right after 1987 and the Great Depression. And this is where things go from a normal drop to a disaster. Because when a market is built on loans, you don't even need anyone to want to sell. Automatic selling happens. They call it a margin call. It means when a stock you've bought with borrowed money drops enough, your broker sends you a message, either deposit more money right now or we'll sell your shares ourselves. If you don't have any money, the broker won't wait for a better price. They'll sell it right then and there, at whatever price it is. Even if you're down 40%, this forced sale pushes the price even lower, which causes the next group to get margin calls too. And that leads to even more forced selling. An endless loop. Under normal conditions, only 2% of leveraged accounts in Korea get liquidated like this. But during this crash, that number went over 10%. That's 5 times the normal rate, and leveraged funds made things even worse. Because these funds have to be balanced every day. So in just one day, the fund is forced to sell again in the middle of a falling market just to maintain its leverage ratio. So that means both regular investors were getting liquidated, and at the same time, the funds themselves were selling too. In just 2 days, more than $600 billion was wiped out from all Asian markets. Japan, Taiwan, Hong Kong, they dragged everyone else down with them, and here's an interesting historical point that rarely gets mentioned. Japan had already seen this movie once before. In the late 1980s, Japan's real estate stock market was in such a bubble that, on paper, just the land under the Tokyo Imperial Palace was worth more than the entire state of California. When that bubble burst, it took Japan's stock market nearly 30 years to return to its previous peak. South Korea is now experiencing a faster and more condensed version of that same story. Alright, now let's get to what really matters. America. Right now, the leveraged debt in the US market, that is, the total amount of money people have borrowed to buy stocks, has reached its highest level ever. If you look at history, every time this number has hit a peak, a major crash has followed. In 1968, right before the market lost 2/3 of its value. In 1987, 2 months before the worst day in US stock market history. In 2000, exactly the same month the dot-com bubble peaked. And in 2007, a few months before the global financial crisis. And unfortunately, right now, in the summer of 2026, this number is higher than all those points. Higher than the dot-com bubble, higher than 2007, higher than the meme stock bubble of 2021. But this number only counts official broker loans. Leveraged funds, options trading, private credit. None of these are included in the statistics. So the real figure is probably much higher than what's officially recorded, and those same leveraged funds that wiped out investors in Korea also exist in the US. Double leveraged funds on single stocks like Nvidia and Tesla with hundreds of billions of dollars invested, plus daily options trading where people bet on what will happen to the market in the next 6 hours. Now let's see what's keeping this market standing. The 10 largest American companies make up 36% of the entire stock market, and almost all of them are standing on the same bed. Artificial intelligence. Nvidia sells checks. Microsoft, Meta, and Google buy the chips. Micron supplies the memory, and all this money just circulates among these few companies. A famous investor who had previously exposed the Enron scandal recently said that the returns on AI spending are decreasing. A year and a half ago, for every dollar the big American companies spent on artificial intelligence, they made 40 cents in profit. Now, this number has dropped to 20 cents, and if this trend continues, it'll go down to 10 cents. And in this situation, companies are going public at an incredible pace. This year, the value of companies newly listed on the stock market has reached 12% of the total US GDP. The previous record was during the peak of the dot-com bubble, and that was only 5%. But now it's more than double that. This means we're witnessing the worst bubble in recent American history. Yet, we still see new companies entering the market. When this many companies are rushing to sell their shares, it usually means they believe this is the best price they can get. So the main question is, what will burst this bubble? The answer is just one number. The capital expenditures of the four companies, Microsoft, Google, Amazon, and Meta. Just these four companies, with the decision in a single quarterly financial report, can shake up this entire structure. Just think about it. The South Korean market fell apart just from concerns about a slowdown in memory spending. Not because of something that actually happened, just because of a worry. Now, imagine if one of these four American companies said in their financial report that they're cutting back on AI spending. That's exactly what happened to Cisco in 2000. Coca-Cola, which used to order 10,000 routers from Cisco every year, only ordered 2,000 in 1 year. That single decision destroyed Cisco's revenue and wiped out nearly 80% of Nasdaq's value. If just one of the four big companies cuts its AI spending by even 20%, it might not have a problem itself. But the revenues of Nvidia, Micron, Samsung, and SK Hynix would all collapse together, and in the end, we're left with only two scenarios. In the first scenario, South Korea stays limited right there. Memory prices remain stable. AI spending continues, and the Korean market gradually comes back to life. In the second scenario, South Korea was just the first domino, and as soon as one of these four big American companies cuts its expenses, that same vicious cycle, that same forced selling, that same final loop the Koreans experienced will start in a market with the highest leveraged debt in American history. Right now, analysts are saying with complete confidence that artificial intelligence will keep growing and that this is definitely not a bubble. But there's a saying that always sticks with me. In 1912, when news came that the Titanic was sinking, the vice president of the company that owned the ship said, "We are completely confident that this ship is unsinkable." He said this after the ship had already hit the iceberg, when the ship was actually sinking underwater. 14 million Korean investors had that same complete confidence just 3 weeks ago. This video is not financial advice. I'm not saying you shouldn't invest your money. I just want you to know what's happening right now and to be careful with leverage and debt, especially right now. If you found this video helpful, make sure to like it, and if you haven't subscribed yet, do it now so you don't miss the next video.